Portfolio, as we already have some background of this term, portfolio means you are making a combination of various assets in your investment plan. Naturally, it's up to you to decide which assets you have to keep or where you have to invest. But whatever plan you will make, if you are taking different assets or different securities, or you are investing in different uh, um, assets, then you can call it a portfolio. So naturally, there is another question which will arise, that how we structure portfolio, and what would be the basic plan if you are planning to invest in various assets. And the last topic that we will cover will be related to risk aversion, that how investor behave in the market and what are the concepts he has in his mind about his investment plan. When you are making a combination of different assets and you are investing your funds in different stocks, bonds, then this combination will be called a portfolio investment. For example, an investor is deciding that he will make certain investment in a stock, and he's not only investing in stocks, he's also taking investment in bonds, and he also deposited some amount in a bank to secure his diversification plan. So in this case, whatever investment plan he is making, if he is not investing all his investment at one place, then the combination of assets that he will plan will technically be called portfolio. Just giving an example, that suppose you have a total fund of 500,000 and you decided to invest this fund in various assets, that how can being an investor you can structure a portfolio. Suppose this was the total fund that we discussed, that you have 500,000, and in your portfolio you decided that you will invest in stock A 50,000. You also plan that you will keep in your bank account. Let's assume that you are keeping a fixed deposit of 100,000 in bank. Technically we call it TDR or fixed deposit. You also plan that you have to invest in gold market 200,000, and the last item that you have selected is a stock B, in which you invested 150,000. If you carefully see that I have a total amount of 500,000, but being an investor, I decided to invest at not only one place. I am investing in stock A, investing in fixed deposit, keeping some amount in gold. So all this combination that I made here will be called portfolio. So in my portfolio, if someone is asking, then I can say that I have two types of stocks. One is a stock A and a stock B. And second, I have some amount in fixed deposit, as well as I have invested in gold. So this entire plan is taken as a portfolio. So naturally, there is a second question arises, that if I am making this investment, that what percentage I am investing in stock A, what percentage I am investing in fixed deposit. So this we can do with the help of this slide. You can see I'm making 50,000 investment in stock A. I'm keeping 100,000 in stock B. So if we are interested to find out its weight, or in simple terms, you can say that what is your investment plan in different portfolio structure. So we can calculate the weight of each and every investment that you are making. I'm making 50,000 in stock A, and the total sum is 500,000. So I will take the individual investment that I'm making and will divide it by the total sum that I have. So its percentage is coming 0.1. It means that I'm making 10% investment in stock A. I'm having 20% investment in fixed deposit. I have 40% in gold, as well as 30% in stock B. So the entire portfolio is split into 4 components, and the total sum will show your total investment in your portfolio. Risk aversion is a basic assumption that whenever you are investing in market, being an investor, or in case if you are dealing with any investor and is trading finance, then you will keep it in mind that whoever investor you are dealing with, uh, there will be a certain basic assumption behind it, that every investor will be assumed that he is trying to minimize his risk and maximize his return. Just suppose that this is the situation which is given. There are two investment. Investment A, where we are able to get a return of 12% while the risk is 5%. Another investment we have, and there too we have a return of 12%, but now in this case the risk is 7%. Now the question is, which investment should I prefer? So in this case, remember that since I am having return same in both the cases, so I will try to minimize my risk. So rather than moving on 7% risk, I will move on 5% risk. So naturally in this case, my investment preference will be to investment in A rather than in B. Now suppose this is the condition which is given. In previous lecture we discussed that the return was same in both the cases, but over here you can see that in investment A you have a return of 10% while risk is 4%. While in investment B, we have a return of 12% and the risk is 5%. So carefully see that if return was less, so risk was also less. But as return is increasing, so risk is also increasing. Now the question is, should I go to the first one or should I go to the B one? In this situation, as you have already done in the coefficient of variation concept, so rather than directly taking the decision, we will convert both the information into coefficient of variation. So in case of coefficient of variation of investment A, we have a 40% risk on 1 unit of return. And in case of investment in B, we have 41.7% of risk compared to return of 1%. So in this case, we would prefer investment A. Of course, it is giving less return, but it is less risky as compared to this one. So in this type of situation, when you have a different return and different risk, so taking a decision is based on the coefficient of variation. Investor choice is important, and being an investor, you have to keep it in mind. Being a manager, when you are dealing your portfolio, when you are dealing with different type of investors, the basic concept that should remain in your mind, that whenever you are dealing with any investment plan, you will try to minimize your risk and try to maximize the return. This will help you a lot when you are dealing in various cases.